It's a new calendar year, and what better time than to start thinking about how you can legally reduce the tax you pay. I'm going to share with you the tips that I see as an accountant that my successful clients are doing to legally reduce their tax paid. I'm also going to throw a bonus money saving tip at the end, so make sure you stick around for that. Hello everyone, my name is Ethan Rushop and today's all about saving tax, and let's jump right into it. And the first one is understanding your occupation/business. So if you're an individual working for someone, understanding what your occupation is. If you're a business owner, understanding what industry your business operates in. And it's really important to have an understanding of what you do, because then that's going to allow you to understand what's deductible. So if you're a nurse, you want to understand, well, what is deductible to a nurse? You know, my nurse's registration fees, my union fees, etc. If you're a tradie, what is deductible to tradie? Maybe you're working outside so you can claim some kind of protective clothing or sunglasses. By understanding what industry you operate in, it's going to better allow you to claim more deductions and therefore reduce tax paid. Now, do chat to people that are doing the same occupation as you. So, chat to workmates about what they're claiming, but always validate this with research, especially if you're doing your own tax return. Don't just claim something on your tax return because your mate said he claimed it as well. Go and do a bit of research. Go to the ATO website. They actually have some really good occupation-specific fact sheets where you can actually see what could be claimable for a nurse, for instance, and what isn't claimable. They kind of highlight, hey, you can't claim this, but you can claim that. So by understanding your occupation, you can really maximize your legal work deductions for your tax return. The second tip is taking photos of all your receipts as soon as you get them. The biggest mistake people make on their tax returns is not claiming everything they're legally entitled to claim. If you've actually spent the money on something, you want to claim it if it's claimable. Like, that's just common sense. If you've gone and bought some work clothing that is deductible, make sure you claim it. And the biggest reason why people don't claim it is because they either forget or they don't have the receipt. So by taking a photo of the receipt straight away and having some kind of system where you store it, whether it's on your phone in a folder called tax receipts, whether you're uploading it to Google Drive or Dropbox, having a system to go, yep, I'm going to capture that expense and I'm going to save it, and therefore at tax time I've got them ready. If you receive it by email, drag them into a folder that says tax receipts. It can be as simple as that. You can go one step further and use a spreadsheet or even use the ATO app. There's multiple ways for you to do this, but you want to capture them when they happen. If you're not capturing when they happen, this is the most likely that you're going to forget they've happened. So I've seen people try and go, oh yeah, I did spend money on that, but I can't remember how much it was. And I'm trying to drill, go, well, do you have any idea? Is it on your bank statements? And they can't find it. And then in the end, they miss out on a deduction. Or they're claiming a deduction, and then when the ATO comes along to do it, they've got no backup, no evidence for this. So capture your evidence no matter how it happens, whether it's a digital receipt, whether it's a printed receipt. Make sure you capture that at the time and have a system to store it. Now, before I get into the next tip, I've set the goal here in 2023 to get to 10,000 subscribers on YouTube. I'm just over 3,000 at the moment, so I'm definitely going to need your help. So please hit that subscribe button if you haven't already, and share these videos around with your friends. It's really going to help me grow this channel and keep making more content for you guys. Anyway, let's get back into the video. The third tip is structuring your investments or business operations or rental properties in the best way possible from a tax point of view. And this might require a bit of planning when you first go to do something. So there's not a lot you can do with employment income. Unfortunately, you can't just direct your employment income to a trust and split it amongst 50 people. It will likely have to be attributed to yourself. But other things like investments in shares, crypto, or maybe it's a rental property, or maybe you're running a business on the side. These things potentially could go into some type of structure or just be held in a way that is going to be more tax efficient than just being 100% in your own name. So there's probably three main things you're looking at. You're either going to look at, do you need to use a trust structure, a company structure, or is it just a different split of ownership percentages? And we'll quickly dive into each of them. So do you want to look into a trust structure? Maybe you've got some investments and you're going to be investing in some shares or some ETFs or some crypto that are going to pay you regular income, and you're on a really high income. Well, maybe you want to direct those investments into a trust that has multiple beneficiaries, and at the end of the year you can split that income between the other beneficiaries. Maybe it's your wife, or maybe you've got some adult children that you're going to give some money to anyway, and therefore you want to distribute some of the funds through to them, and it might be more tax effective. The second option is maybe you're going to look at a company. Maybe investing in a company might be worthwhile for you. There's some things you need to understand with capital gains discounts, etc., but it might work out well for you. Or maybe it's a business you're running through a company and you know that it's in the startup phase, or it's going to generate lots of profits, or there might be different reasons why you want to do that. having a chat to your accountant before you start this business is a great opportunity for you to really understand, is this the most tax efficient way for me? Or maybe you're buying a rental property and you want to look into, well, should this property be in 50-50 names? Or maybe should it be all in my partner's name? Or maybe we should have a 99-1 split or something like that. It really is an easy legal way to reduce your tax paid, and it's what a lot of successful people are doing. You hear it all the time of rich people that have got their investments or businesses structured in a way where they're massively reducing the amount of tax they're paying. People might not like it, but if the advantage is there for you to take advantage of, why not do it? The fourth one is salary sacrificing. So if your employer allows you to salary sacrifice, it's nearly always a good idea to do it. Now, this is definitely not going to be available for everyone for everything. So if you're working for a non-profit or a government organization, there's definitely a much higher chance that you will be able to salary sacrifice. And in nearly all situations, it makes sense to do the maximum amount. And the reason for this is you're reducing your income before it's taxed. So you might be salary sacrificing $200 a week, and that's coming straight off of your income before you pay tax on it. So it's a very easy, simple way to reduce your tax paid. Now, I do wish this was available for everyone, but like I said, it's not. But have a chat to your employer about if you can. And normally if you can, if you're working for a not-for-profit, for instance, and they allow it, it's pretty broad on what you can salary sacrifice. You know, you can salary sacrifice your mortgage, you might be salary sacrificing a car, etc. Or you may even be able to just get a card where money goes onto that and then you can spend that freely. So it's a pretty broad concept. I'm very surprised it's still allowed, to be honest. But it is definitely a very easy way to reduce your taxable income. Now, nearly everyone will have the option to salary sacrifice into super, so adding more money to your super is definitely going to be a tax deduction, but that's a really specific area and you need to get your own advice. You need to make sure putting money into super is actually right for you, so go and speak to a professional or do your own research into this before you make that decision. Now, I did say there'd be a bit of a bonus money saving tip. So my money saving tip, and it is directly related to tax, is ask your workplace what they will pay for. At the end of the day, if you can get your workplace to pay for any of your work related deductions, you're going to be in a better position in the long run. I do hear a lot of people go, oh, I didn't worry about getting reimbursed from work because I just thought I'd claim it on tax. You are much better to get your workplace to pay for it. And the reason for that is you can never save as much in tax as what you would if you saved the whole dollar. The average tax rate that a lot of people on when you add in the Medicare levy is about 34.5 cents. So if you've got a $100 thing that you need to buy for work, if your workplace pays for it, it'll obviously cost you nothing. If you pay for it and claim it on tax, you're going to reduce your tax paid by $34.50, but you're still going to be $65.50 worse off than if your workplace had just paid for it. So by just asking that question, you never know, they might go, hey, yeah, we'll happily pay for that, or hey, look, you pay for it and we'll reimburse you. You're going to be in a better position overall. I think this just shows that saving money really does go beyond just the tax side of things. And I've done a video talking more about wealth creation and what's the best way to increase your wealth. So go and check that one out next, and I appreciate you watching.